Hello, today I would like to talk about why global diversification is a myth and why I'm putting all my money in the United States stock market. Earlier on my journey as an investor, I was led to believe that the best thing that I could do with my portfolio was to diversify globally. So I did. I bought a little bit of the US index and a little bit of the Canadian index and the European index and the Asian index and the emerging market index, and you name it. I bought a little bit of all of them. Eventually, I realized that it just didn't make any difference. Everything is correlated. I couldn't protect my portfolio from what is called country risk, because if one country went down for whatever reason, every other country went down as well. More particularly, if the United States went down, let's say the United States have, low unemployment or high inflation or whatever the reason, if the United States went down, every country around the world went down as well. So it just didn't make any sense to diversify at all. Let's start with some random facts. The United States now represents over 50% of the global market. So from that perspective, everyone in the world should have at least 50% of the portfolio invested in the United States if they want their portfolio to truly represent global equities. Let's consider an example. Nvidia, which is one of the biggest corporations in the world right now, it has market capitalization of $3.4 trillion. Company is bigger than the whole stock market of Germany, which has a market capitalization of $2.3 trillion. This one company is bigger than the whole market capitalization of the French stock market, which has $2.8 trillion. This one company is bigger than the whole United Kingdom stock market, which only have $2.5 trillion. One company is bigger than the stock market of France, the stock market of Germany, and the stock market of England. So why specifically I like investing in the United States? Well, I think the United States is one of the most innovative places in the whole world, and they are in the business not of selling products but of selling ideas. So let's consider some of the biggest companies in the world, which are Apple, Microsoft, Nvidia, Amazon, Google, Tesla, Facebook, Airbnb, Uber. You know what these companies do? They sell ideas. So let's take an example of Apple. Apple designs phones in California somewhere, and they are produced in China and in India. Let's look at Nvidia. Nvidia also designs their microchips also in California, and they are produced in Taiwan and other countries. Let's consider other companies. Let's consider Airbnb. Airbnb is basically an app. That's what they do. They created this app, people who rent their houses with people who want to rent their houses. So it's an intermediary who owns practically none of the properties that he rents. Let's consider Uber. Uber is also an app on someone's phone that puts together someone who's willing to drive with someone who's happy to be driving somewhere else. So it's a producer of an idea. They created this app, and that's how they make their money. Let's consider Google. What does Google sell? Google sells just this search box on top of your phone and your computer where you can search stuff. So it's also a seller of ideas. And what is it? Facebook. Facebook sells a page where you can connect with your friends. And Microsoft sells productivity software. So all these companies are in the business of selling ideas. The only company that I see that is one of these major companies that produce something physically is Tesla. Tesla produces, of course, the automobile Tesla, and they produce it in China, in Germany, in the United States. They sell it globally. But all these companies, they were born in the United States, and they have expanded globally, and they affect the global stock market. So from my perspective, the globalists have won. Everything is so interconnected that it's just almost impossible to untangle. If you want to invest exclusively in the United States, it's not possible. All the United States companies are multinational. Let's look at Apple, for example. If you buy Apple stocks and there is a labor dispute in China, for example, then your Apple stock is going to suffer. There is no escaping this globalism. Your portfolio is exposed to what happens in other countries, even if you only buy US securities. So let's look at some other examples of global interconnectivity. Let's consider Saudi Aramco, which is one of the biggest oil producers companies in the world, which is based in Saudi Arabia. Okay, so let's say there is a depression in the United States, the gas demand would decrease, Saudi Aramco stocks will go down. So, or vice versa, let's say that there is a problem producing oil in Saudi Arabia, then this will affect the whole United States economy. Or let's take another thing, Rio Tinto, which is a mining company based in Australia. So let's say that, I don't know, they produce copper and something happened to their copper production. Maybe they went on a strike. Okay, so now we cannot consume copper in the United States, which affect housing. The prices of houses could go up, or electricity or connection, electric connectivity among the world. So all this is to highlight this longer isolated to one particular company. Saudi Aramco is no longer a company that affects exclusively the economy of Saudi Arabia, it affects the whole world. Rio Tinto is not a company that affects exclusively the economy of Australia. It affects the whole world, and the same by the same token, the demand that there is in the United States also affects directly those companies. So everything is just too interrelated, and all this happens in the stock market in general. The stock market in the United States could easily go up or down 1% every day for no reason at all. But let's say it goes up or down 2%. So these effects are magnified so let's say the stock market in the United States dropped by, then the stock market in India or Brazil, it could go down by 4%. The effects of what happens in the United States is magnified. Or let's take a look at interest rates. Okay, so interest rates are high right now. Okay, so many countries in the world borrow their money in US dollars. The interest rates are high. Many of the countries, they find a difficulty of having to pay those interest rates in US dollars, and many of those countries could default. Like Argentina has defaulted so many times, and there are many other countries that in Africa they just cannot pay and so when Ben Bernanke thinks about interest rate in the United States, he's not supposed to be thinking about what will happen in Indonesia, but I bet you that he thinks about those things. You know, we're gonna increase interest rate by 1/4 point. Well, he has to think, okay, but this 1/4 point may bankrupt another country in Southeast Asia, and although it's not his responsibility to think about that, I'm sure he does think about that. And the idea of globalization is nothing new. It's an idea that has been around since the 1700s, when economist David Ricardo came out with his theory of comparative advantage, which simply means that, let's say, Portugal is good in producing wine and Porto. Okay, so Portugal should dedicate itself to produce this wine, and let's say France is good at producing French baguette. So that's the comparative advantage. So France should produce French baguettes and then exchange, and that by doing that, both countries will be better off. Okay, so this is an idea floating around in the 1700s by these economists. But then later on, we have in 20s Thomas Friedman, who wrote a book called The World is Fat. The World is Flat. And what is he saying? He's saying that with all the communication that we have, all the technological advances that we have, intercommunication, and the logistics advances that we can produce something in China and have it shipped to the United States for almost nothing. Well, also interconnectivity has increased. It has increased to the point that every country is producing the goods or services that is better suited for them. So it's happening that in the United States, the goods and services that they are selling that are worldwide known now is just this thing that we spoke about a minute ago, which is the business of selling ideas, selling innovation, selling design, selling apps that transform the world. So if there is no real reason for global diversification, why choose the United States stock market to put my money in instead of other countries such as, for example, Canada or Germany or England? Well, from my perspective, the United States stock market has a more liquidity, has more transparency, and has lower costs. So it's just a place that has become good at running a stock market, better than everybody else. So that's where I'm putting all my money. But the reality is that the United States stock market is no longer the United States stock market. It is the world's stock market. And one of my favorite investments, in fact, my favorite investment is the S&P 500. But the S&P 500 doesn't represent United States companies. All those companies are global companies representing the whole world. So that's my conclusion. I'm putting everything in the US stock market because it represents already the whole world, but it's the most efficient place where I put my money to work for me. Thank you so much for watching, and until next time, peace.